We're clearly seeing investors' fantasies being shattered. Our economic reality has become way too oppressive, and hopes for brighter days are being turned into deception. Last month, the stock market has benefited from what experts call a bear market rally, when stocks climb higher for a brief period within a longer-term downward trend, although many believe the worst was behind us and that things were starting to fall back into place. The outlook for a deep recession seems to be crushing optimistic predictions for next year. In fact, as Albert Puero, trader and co-founder of Sala Paratraders, notes, the U.S. Federal Reserve is now pointing to the highest odds of a recession in the next 12 months at 45%. That is the highest on record. If the Fed sees a 45% chance of a recession, the probability is clearly much higher, highlights the analyst. We're actually entering what could be seen as the second stage of the Great Unraveling, when a sell-off in stocks and dropping real estate values combine to create a major collapse in asset prices as the reality of a severe economic recession. And now, it's time to dump risky stocks before another sizable slump occurs. Morgan Stanley's U.S. Chief Investment Officer just rang the alarm that stocks could drop as much as 24%. Now, RIA Intel reports that nearly 9 in 10 wealth advisors, 88% to be exactly, going headfirst into alternative assets, things with a low correlation to stocks, including contemporary art. The numbers show that contemporary art has a negative 0.04 correlation to developed market equities, basically major stocks, and less than 0.3 correlation to other asset classes. For reference, hedge funds have a 0.77% correlation to developed equities, meaning they are far more correlated. And if you find all this very complex, don't worry. Udemy is there to help you. Udemy is an online platform where you can get unlimited access to 19,000 plus top Udemy courses, anytime, anywhere. There are hundreds of diverse categories out there. Choose the category and course of your interest and start learning. The link is in the description below, and by using my link, you can get a whopping 40% discount on all courses. Now, coming back to our topic, given that the S&P 500 ballooned by 113% over the past 2 years from its market bottom, which was recorded in March 2020, it's safe to say that the correction in stocks is nowhere near its end. We're still in the middle of an unprecedented asset bubble induced by excessive liquidity from the monetary and fiscal policies issued by the Fed. And financial markets are finally waking up to the fact that getting rid of inflation may be way harder than central bankers previously thought. Powell also announced that the central bank will continue hiking rates through 2023 and projected its Fed funds rate to peak at a higher than expected 5.1%. Losses continued to pile up last week, with the Dow Jones Industrial Average falling over 760 points, right after U.S. jobless claims and retail sales data were released. Meanwhile, the S&P 500 dropped by 2.5%, bringing its decline for December to about 4.5%. The sell-off was so broad-based that only 14 stocks in the index closed in positive territory. Many mega-cap tech stocks declined, with shares of Apple and Alphabet down more than 4%, while Amazon and Microsoft were lower than more than 3%. Shares of Netflix fell 8.6%, following a report exposing that the streaming firm is offering to return money to advertisers after missing viewership targets. The Nasdaq Composite tumbled 3.23%, stretching his 2022 losses to nearly 31%. A disappointing retail sales reported warnings of industry oversupply indicated that inflation is still a major problem for consumers. Not even Black Friday helped retailers get rid of excess inventory, and sales actually failed despite deep discounts, according to the Commerce Department. The second phase of the drag down in equities is being driven by a free fall in corporate earnings, as economic activity shrinks in a lagged response to rate increases. Author and professional investor Daniel Akire explains, the more earnings fall as the economy splatters them, the more stock prices will decline. And at this point, it's become evident that a soft landing isn't in the cards anymore. In the past few days, many major financial institutions have issued warnings about a turbulent 2023, Strategists at BlackRock's Investment Institute wrote that the Fed's actions are likely to fuel the sell-off in stocks in 2023 as its tightening campaign plunges the U.S. into a recession. Getting inflation down means they need to crush demand, making recession foretold, they stressed in a research note published last week. Over the last 7 days, Goldman Sachs CEO David Solomon is warned of bumpy times ahead and a tougher economic environment, while the bank's chief U.S. equity strategist David Kossin has said the S&P 500 will remain flat through 2023 and that the index will see a near-term decline to 3,600. On the same note, J.P. Morgan CEO Jamie Dimon has predicted a hard recession in the first months of the next year, while Bank of America's Savita Subramanian said she expects stocks to have a rough start to 2023 amid tougher conditions for businesses. Wells Fargo strategist Chris Harvey wrote in a new note, "We expect 2023 to be a back and forth year with double-digit sell-offs driven by Fed and economic concerns." According to Morgan Stanley Chief Investment Officer Mike Wilson, the bear market is not over. We've got significantly lower lows if our earnings forecast is correctly revealed. But one of the most chilling forecasts has come from Deutsche Bank. The investment bank's analysts explicitly said they expect the Fed to break the market in the coming months. If we look back at history, we are very likely to face the recession and potentially a quite severe one, they wrote. Everyone could tell the stock market was in a historic bubble that would explode as interest rates started to rise. What we didn't know was how much chaos the come down would bring. The bear market doesn't run on a controlled schedule, but interest rates certainly do, with a new series of rate hikes expected in 2023. The stock market seems to be falling off a cliff so steep that we still cannot see the bottom. This downfall is gonna be a brutal one, and the whole financial world is starting to see it. The great financial reckoning has been warded off for too long. Now all the stocks can do is fall in a spectacular fashion, given that this bubble has been not quartered, not years, but over a decade in the making. The only thing left to do is to let the crash run its course and get out of the way. So how long do you think this recession will last? Until where will it drag the stock markets? Let us know your thoughts in the comments section below. Thank you for watching, and if you enjoyed this video, and if you want to keep tuned with stock market and finance-related news, subscribe to our channel and turn on the bell to always get our latest notifications. See you in the next video.